Good afternoon. Welcome to the TheoTRADE afternoon video. I'm Blake Young. Today is June 3rd, 2024, and we're going to talk about the dollar, bonds, and bullion cause a renewed lift in commodity prices. The dollar sold off today, and actually it wasn't just that it was a down day. It was a down day that closed at its low and appears to be completing the head and shoulders pattern. Now that is a major threat to the US dollar. The US dollar, if we're going off a technical price perspective, we could see it sell off the top of the head to the neckline. And if we were to measure that as a percentage, and we'll go off the high shadow to the neckline's low shadow. Well, let's go off the close because that's where we finished out the day. If we measure that as a percentage move, the dollar fell about 2.23%, which means we could see it go 4.46 if it just completes this pattern. That means we're looking at the dollar falling back all the way back to retest the beginning of the year. All the strength the dollar gained, if we break out and complete this pattern, means the dollar is going to fall all the way back to almost 100. But mainly we're looking at the open of this 2024 year. All that strength gone. So why is the dollar selling off? It's tied primarily to bonds. When we see bond prices moving, and we see bond prices, specifically the 10-year, bouncing up, you would think that we have higher demand. Well, higher demand and lower interest rates, we are pricing in rate cuts. That's what we're pricing in again. The market doesn't seem to believe the Fed that we're not going to be raising rates, that we're not going to leave rates alone, and are pricing in those rate cuts again. So this significant bounce in bonds over the last 3 days has erased almost a week and a half worth of bearish movement in bonds, and that means yields are falling. So the dollar is falling because it's not as an attractive place to park money. If the rates or the yields that they provide are falling, and we're approaching a breakdown here, that is going to reflect in the dollar's purchasing power. And if it's truly a hedge against inflation, we should see gold prices moving higher as well. And what do we see? Gold bounced, strong bounce off of support. It did not move up to the highs like we could have expected, but it's a solid bounce. Now, is that the time to buy? It's a good bounce. It's a good support. The previous highs are up here at 245. It could sit here in a sideways pattern as we trade back and forth and fighting this. But if we take a look at other commodities, let's go look at copper. Copper bounced today and did close above its previous high, which means that that is a better bounce from a technical perspective. If we were to look at this and say, show me general commodities as DBC, Deutsche Bank's commodity fund, we're not getting strength there because we're being weighed down by crude. So crude prices are selling off, and crude prices dropped down very aggressively, erasing all price action going back to February. So how do we handle this? If inflation is higher, if the dollar is getting weaker, then theoretically commodity prices should be going up. It is not happening because crude is falling. But if we're going to see that hold up and the dollar is weaker, then we should see a stabilization, if not a continued rally in general commodity prices. This, as I talked about last week, is primarily an expectation of excessive supply. It is expected that OPEC could produce 4 million barrels a day excess supply from now through 2025, the end of 2025. And in addition to that, we are not seeing the economy grow, and we're seeing major misses in manufacturing. And it appears that that means that we're favoring a slowdown in the economy and slowdown in demand in crude. What is fascinating to me is, yes, energy prices are falling. Yes, crude's falling, and therefore the energy sectors are going to struggle. But even stocks like XME, metals and mining producers, they did not gain on the bounce, but they are near their highs. So if gold bounces, if copper bounces, and even if they just stay where they're at, that would tell us that metals and mining are profiting from this sideways move. They are at their max margins. So if they're near their max margins, that is actually a very positive thing for any of the metals and miners. So even though we didn't get a rally in XME, even though we didn't get a rally, say, in FCX, if we look at Freeport-McMoRan, we didn't get a rally, but we're holding near the highs. If we're going to hold near the highs in these metals and mining stocks, and we're holding near the highs in the commodities, then these companies are going to continue to profit, and we should expect to see them with a very solid earnings quarter. And if I don't want to buy the stock because it's just sitting here and not advancing, we will go to the trade tab and take a look at what the options are showing. Number one, FCX has a current implied volatility at 58%. That means there's probably some money to be had by just selling premium. If I'm willing to sell it at 52, we'll walk through that same process we've done in the past. I like to look at it about a month. And if we're looking at a month, let's go with this 25 because it does have higher implied volatility. And we're going to change the layout to show that return on risk. Return on risk tells us how much we get paid for our willingness to buy it at 52, which means that if I get assigned at 52, the $1.78 to $1.84 spread here is equivalent to 3.61%. Just for my willingness to buy FCX, I can get 3.6% for less than a month's worth of time. FCX does have a small dividend that could be of interest, but as long as it holds here, I get paid that safety net of $1.80. We'll just call it a round number of $1.80. 3.6% for my willingness to own FCX near the highs as commodity prices, gold and copper, hold near the highs. Now, one of the other stocks that we didn't look at yet is Newmont. And if you look at Newmont Mining, Newmont is near these highs as well. It did not sell off like some of the others, didn't gap up and close down. It traded very, very flat, but it is also near its previous high. If we look at the trade tab here and look at the options, the implied volatility on Newmont is at 71%, so even higher. If I'm willing to own Newmont at the current price, and I look at the same 25 days, they're paying 2.5%, but even though a little bit lighter than what we saw in Freeport, its yield is a little bit higher too. So we could sell that, collect $1 against 41, and then potentially collect some dividend on Newmont up here near the top. One other one I like to look at is Southern Copper. If we go to SCCO, Southern Copper did sell off, but it has 77% implied volatility. We do not have the weekly options, so we'd have to go out to probably 46 days. They're willing to pay us 5% for 46 days. There's no dividend on this, but if you think that copper is going to hold up near these highs, then we could collect 5% at 115, which means that you'd be buying it for about $110 minus $570. So your break even on this would be $109.50. So the idea of buying it here is like buying it down at the next support and actually through the next barrier. All of these work out as far as collecting some premium while we wait to see if this is going to go higher. If metals and mining stay high, then these should be able to maintain their value up here near the top. The last commodity related thing I want to look at in conjunction with the weakness of the dollar and these changing rates or treasury rates is Deutsche Bank's Agriculture Fund. Now the Deutsche Bank's Agriculture Fund is also nearer to its peaks than it is to its troughs. It's very close to its previous highs. And if you wanted to trade DBA, you could certainly do that. But I want to take a look at Nutrien, and if that's how it's pronounced, NTR. And Nutrien is similarly near the tops. It could create a little head and shoulders pattern, but sitting here, if we expect commodity prices to stay high and if we expect food prices to stay high, this one isn't paying us as high of premium, and it could be a long stock opportunity. You can see if I scroll down, way down here, you can see that it's the 38th percentile as far as current implied volatility. It might be worth just buying the stock up near the top and selling premium against it as you reach to higher levels as the spreads are a little bit wider. So it's more of a stock play than anything else, but I do like the fact that agriculture prices have remained relatively high. This company is the one that bought out potash a while ago, and they have the ability to get up to significant highs. Obviously, we're back at $69 last year and has really been a benefactor of high agriculture prices and high demand in the farming industry. So if NTR continues to move higher, if this is retesting its lows, I do think it could get all the way back up to $69. And as a percentile, going from the current price up to last year's highs, we're talking about nearly a 20% rise in price. Well, that's going to do it for me today. Thanks for watching. We'll look forward to talking to you again next week. Otherwise, have a great week.